Thank you, everybody, for joining us on this episode of the hugely popular Cummings Pepperdine Crypto Questions. Now, anybody who knows me will say that whenever I talk about a market, I say that there are only three things that matter. And those three things are liquidity, liquidity, liquidity. And it's with that in mind that I'm absolutely delighted today to have Joseph Edwards with me, who is the head of research at Enigma. Now, Enigma is a liquidity provider with offices around the world, and Joseph is talking to us from London. So, Joseph, hello, and thank you very much for joining us.
Pleasure to be with you.
So, Joseph, tell us a bit more about your work with Enigma and whether you agree with me that the three things you need for a market are liquidity, liquidity, liquidity. What's your view on that?
Certainly. So Enigma, for people who don't know, we are an LP sprung out of the McCaw Group, which is a equities FX brokerage group established in 2010, I believe. So we've been going for a while. We set up the Enigma desk in 2017 because we saw, obviously, McCaw only services institutional clients, and we saw quite a high demand for essentially crypto in a market that crypto from a source that people could trust, right? Because essentially our birthright, our conception came from this concept of liquidity, right? Because the problem that people had was you go back to it's about 2015, 2016, right? And there's a bit of a case of, well, why didn't people in the institutional world take crypto seriously at that time? And the answer comes down to liquidity, because they were seeing these prices, they were seeing these markets, but then they were seeing that these exchanges, they weren't
trading out very far at all, were they?
No, exactly. They were quoting a certain price, but you wanted to buy $1 million worth of Bitcoin even when the market cap of Bitcoin was, let's say, 10 billion, because I think it got to 10 billion at the 2015 run. Yeah. You couldn't buy $1 million worth of Bitcoin. You just couldn't, because, well, you could, but if you were going to buy on an exchange, you suffer massive slippage. You could potentially do it OTC, but you were still probably going to suffer slippage.
And there'd be so many parties involved that the costs would go up, and unless you were very careful, you'd potentially move the market against you.
Exactly, yeah. So this was kind of essentially what Enigma as a whole was sprung out of, was this need for liquidity. And it's one of these things where liquidity is so important in so many things, because it's not just a case of, okay, well, we need it for the basic operations of the market. That is the case, but liquidity also you need liquidity to bring a certain degree of trust and a certain degree of trust in what you're seeing. And this has been, I mean, funnily enough, if you look at the US example, this has been one of the major things that has stopped the adoption, stopped sort of the creation of greater products based on crypto in the US. Not just in the sense of, oh, we can't create this product because it's not liquid enough. Even in markets that are now liquid enough, because of the past liquidity, there's almost a degree of distrust. So the example that always comes up here is, obviously in the EU, we do have crypto ETP exchange traded products, right?
Yeah.
The US doesn't have them. The US obviously has the Grayscale GBTC Trust, which is this whole entire mess right now.
Yeah, it's that sort of inability to really sort of make up, is it a security or isn't it? Yeah.
Yeah.
And there seems to be sort of a tussle going on there between various different state organizations and the market. And yeah,
but the problem is, obviously, well, what you do actually have in the US is you do have ETPs now for Bitcoin, but they're based on derivatives markets. Now, why are they based on derivatives markets? Because the SEC has said, well, we're happy to approve the derivatives-based ETFs because they're based on CME market, CME pricing.
Yeah.
We're not happy. We're not agreeing anything spot-based, because the spot-based ETPs are based on the spot markets, and the spot markets are unregulated and for a long time were illiquid. So there's this perception that still endures because of the previous liquidity that, okay, well, these markets can be manipulated. Now, it's not been the case that wide-scale market manipulation is possible at least in Bitcoin for quite a few years, because the markets have become too big, the markets have become too liquid to allow that.
Yeah.
But it was certainly 2015, you certainly could say that was the case. But the legacy of that previous liquidity is that we can't get a spot ETF through right now. And that's a big problem. But that kind of goes to show you, this is why markets need liquidity, because if you don't have liquidity, they can't be trusted, and that distrust can take a long time to essentially unravel, re-ravel, however you want to put it.
Yeah, and I think as well, when there was lack of liquidity and there was lack of trust, I think there was also as well. I think it's fair to say that there was an element of lack of trust amongst the different parties who would be involved in a trade.
Yeah, so I mean that's something that's obviously been a very long time to sort of unpick. You still really haven't unpicked it now with regards to how the market works operationally compared to how the clearinghouses work in a traditional market sense.
Very much so, and it's, we just have to look at the Sam Bankman-Fried it's the most recent one that.
Yeah, I mean the SBF case is interesting because obviously, well, this is the thing. Because the funny thing about the case is, the whole case of FTX is the assumption among crypto markets, among crypto insiders, was that what was happening with them was essentially they were making their money through, they take these tokens, these Solana-based tokens, they pump them up, and then they sell them at the top and get rid of them, and they book the profits off of that. Now, what was actually happening was these markets were so illiquid, it was completely impossible to actually realize profit on this scheme, quote unquote, without so you had instead this thing where they were loading up against the value of the assets over and over again, right? It's like illiquidity not only makes markets work better, it makes markets more dishonest as a result. And it's one of those things where if you start lying, where does the lie stop? So this is what you saw, this thing sort of snowball out of control as a result of that. So it's really, really important for markets to have liquidity.
Yeah. So tell me about sort of, while we're on the issue of liquidity sort of not working, and I think maybe we can turn after that, we'll talk about some positivity and where we are by comparison and where we're going to go, because I think this sort of history of liquidity and onwards is really important. But on the people who've been caught up, not saying anybody is necessarily a bad actor, I'd say caught up. Silicon Valley Bank.
Mm-hmm.
So what are your thoughts on that?
I mean, obviously, this is a bit of a classic case of the problems that have happened with Silicon Valley Bank, the problems that have happened with all the associated banks.
Yeah.
Essentially are a function of illiquidity in terms of, they've been very responsible in their dealings for the most part, actually, but because they're stuck with certain liquid assets on their books, as soon as sort of pressure is applied, it sort of sent a bunch of them sort of crashing down. And this is why you're sort of seeing, obviously, the Fed response has been quite aggressively to provide liquidity in terms of the new loan thing, the new loan scheme that's coming out today for sort of support these banks. And of course, the conception that people have of this is, oh, well, it's a bailout. Because people look at it and think, oh, you're giving this line of credit to the banks. No, you're not. It's not the case that you're not bailing them out. You're just giving them credit because they have the assets. They are Silicon Valley Bank, unless there's been massive
are
fraud.
There, but they can't actually trade out of their positions.
Yeah.
To meet their to meet their liabilities because of the liquidity issue. Yeah.
So as I understand it, in almost every banking case, in terms of these banks which are now facing failure or closure, whatever, almost all of them, as we understand it, are overcapitalized quite heavily, but the assets are liquid right now, so they can't get out of the positions.
Yeah, exactly. So tell me more about what you're seeing in the crypto markets at the moment, because there's no doubt that we were talking earlier about sort of the early days of 2015, and it's a fairly different picture now. I mean, I'm not saying it's something like the FX market, but it's developing, and it's developing in the right way, isn't it?
Yeah, it's developing quite rapidly. It's one of those cases where I think for those who want it and those who need it, liquidity on at least the Bitcoin and Ethereum as major assets have been in a state now for maybe 2, 3, 4, 5 years where, okay, if you know where to look, you know who to deal with, you can get liquidity, you're not too concerned about sort of the state of these markets. The interesting breakthrough we're kind of beginning to see is that we're seeing more serious liquidity provided on what you'd call these sort of, in crypto terms, large cap and mid cap assets, right? Because obviously there are dozens of assets with market caps, normally market caps over $1 billion. But the case was historically that, well, none of that could be realized because the market was so liquid, you can maybe, I mean, I remember an example we were dealing with a few years ago when we were dealing with one large cap asset. It was a top 10 asset. So this would have been a market cap of in the billions. And we were being asked to sort of liquidate some for a client. And we basically looked through markets and we said, okay, well, they have maybe 50 million, 100 million that they were looking to liquidate. And they were asking, okay, how quickly can you get rid of this? And we looked through it. It's like, if we're lucky, we can get rid of 5 million a day without affecting the market price too badly. Realistically, it might be close to $1 million. And this was on $1 billion cap asset, right?
And let's face it, probably at the moment you've done a couple of clips of 5, you'd have to have been reducing those clips anyway, because people would have known, the market would have seen what you were doing. And it's a very, very difficult one. Right? Yeah.
But we are seeing a case where it's still, I'd say it's still not where you'd expect to see it in even equities, let alone Forex, but we are seeing improvements on those larger assets. And that's going to be the important thing in the next year or two, is that right now, crypto is essentially, when I started doing working with Enigma in 2019, you would say crypto is it's not an asset class, it's an asset, it's Bitcoin. It's nothing else, because anything else
is store of value, that kind of thing. Yeah.
Now we're at the point where crypto is still not an asset class, it's probably 2 assets, right? So this is not downplaying any of the interesting stuff that's going on with these small assets, but as serious assets, the only ones I'd say that you can be 100% sure in terms of, like, you can have full confidence in terms of what they're going to do long term in terms of being liquid enough to get in and out of them, is Bitcoin and Ethereum. The transformation of crypto into an asset class, more similar to equities, where you have a genuine range of assets, you have some genuine diversification assets, that's kind of ongoing.
And you've also got the derivative of, on the asset as well, haven't you?
Exactly.
So, and I think it strikes me from looking at a few numbers that the derivative markets are also trading out further, and therefore giving better pricing and more liquidity.
Yeah, you're seeing maturation of that, and particularly, again, to give an example, when we started trading, when I joined in 2019, you had the CME futures. You could get Bitcoin, you could get reasonable pricing on Bitcoin 1 month futures. That was it. And you could go to the other sources to sort of get longer dated, like longer dated options, longer dated futures, all this sort of stuff, right? But you couldn't trust it to other sources, really.
Exactly. If you wanted to say, I remember a client who set up in 2018, and that was, we were looking at that exactly on the CME, and it took some clever trading.
But it's, I mean, and obviously it's not a case where it's, oh great, I've got the same sort of 1 year, 5 year, whatever that you'd have in certain other markets, but that situation has improved significantly. And it's one of those things where, as the industry ramps up in size, you're going to see the access to liquid markets ramp up exponentially, and therefore the amount of assets that can be considered serious assets ramp up exponentially. That's kind of the process that we're in now. So we'll see how quickly it's realized. But I mean, looking at these sort of...
Yeah, and I think for that to happen as well, you were talking earlier about, who can you trust when you're putting on these trades? I think for the market to ramp up, we've got to have some clarity on regulation, which I think in the UK, I think we're sort of a bit better on that. But the US is a bigger market, and actually that's where the ramping up is going to come from, and it's the clarity on regulation there, which is really going to sort of boost everything along further, I think.
Yeah, and it's one of those cases where, well, it's very much in process, but
well, it's one to stay with, isn't it? It's definitely one to stay with. I mean, it when you think about it, if you think about, just take CME, where derivatives are trading out in 2018, 2019 to where they are now, that's quite, that's speedy. And then when you talk about, as you're saying, one of your large clients trying to get off $1 billion in 2019, again, that's in these few years we've really moved on quite a long way. So tell me, Jason, what's your I think we're both agreeing that the future could be very bright. If you were going to be sort of putting on a long dated trade at the moment, and this is not investment advice, obviously, I've got my thoughts on what if somebody gave you $1 million, where would you put it?
So it's a bit of a case. Well, you'd probably want to you want to be looking to buy very soon if you're looking to buy, because obviously crypto is one of those things where it moves in cycles. Now it will never not move in cycles. Maybe the cycles will get softer, but it will always move in cycles to an extent. And right now we are in a case where we are quite low in the overall cycle. So this is a reasonably good time to buy. I like looking at a research perspective. I tend to think we maybe will see low in the coming months at some point, but this is relatively close to a bottom overall.
Yeah.
So if you're putting it in, it's one of those things where simpler is better, because simpler allows you to have more liquid, it lets you access more liquid markets right now, right? So realistically, you'd probably say something like you'd probably want to put something like the framework that I always tend to use and tend to advise on this is 50, 30, 20, right?
Yeah.
You want to have 50 in one, 30 and 20 in the other. Probably right now you put 50% into Ethereum, just because it has the highest potential. Obviously, this is where the innovation is happening. Bitcoin is great as a store of value, but Ethereum is where the actual scope for innovation, scope for new technology, scope for all this sort of stuff lies.
Yeah.
Probably put 30% into Bitcoin still. And then going beyond that, then it's a bit of a case of, well, the 20% is the hard bit, because you're talking about illiquid markets. So it's kind of one of those things where almost...
I think I would do the reverse of you. I'd put my 50 in Bitcoin, thinking we've got the halving next year.
Yeah.
And then see what that happened, probably staying for at least another 4 years until the next halving. And then I think I'd put 30 in Ethereum, because I still think there are potential for some of the new layer 1 protocols to actually outstrip Ethereum. So I'd be less, I think it's liquid enough for me to get out. And you're right, the 20 is the 20 is tricky. I think I'd probably go across ETPs and the ETFs that are there, with an idea of when more ETFs are listed, then taking some of my 20% into that.
Yeah, the one thing I generally say is, from our perspective at least, I'd say we're looking more towards layer 2s and layer 1s in terms of where the opportunities are going to lie. Like in assets like, for example, Polygon, access like Optimism, which unfortunately Optimism is quite hard to get. Optimism is hard to get market access to right now. But those are the ones which are more interesting. But again, that kind of reflects a more positive view on Ethereum as a whole, right? It's just one of those cases where the layer 1 trades, my kind of thinking on this is there will be a new insurgent sort of layer 1 coming in for next cycle. I don't think it's launched yet. I don't think it has a token yet. I don't know which one it would be as a result, right? So it's one of those things.
There are a number
maybe keep the dry powder. Who knows? But I think if you're saying, well, we've got to put money in now, layer 2s rather than layer 1s, because all the stuff that's being done in terms of zero knowledge, sort of roll ups, all this sort of innovation is happening on layer 2s, and that reflects a stronger bet on Ethereum as a whole. So maybe 50 Bitcoin, 30 Ethereum, 20 on what is basically an Ethereum proxy anyway, if you think about it that way, right?
Well, also the other thing, Bitcoin and Ethereum are very, very different, aren't they? They just happen to have the word crypto related to them. So yeah, exactly. So look, Joseph, it's an absolute pleasure to talk to you. Perhaps sometime sort of, maybe the end of the year or in a year's time, we can come back and we can talk about, the development we've seen in liquidity, the development we may have seen in getting regulation sort of a bit more in order for the sort of trusted people to trade with. And we can reflect on the last year and see how our sort of fantasy trades would have gone. I'm reckoning that this time next year we'll be closer to the Bitcoin halving, so that bit will probably have gone well. It would be interesting to chat about the layer 1s and layer 2s as well, and I think we'll see more ETFs too. So, Joseph, it's been an absolute pleasure. Thank you very much. So, if I could just ask you to just give everybody your email address, maybe, and the Enigma website address. If anybody wants to get in touch, they can do. What's that?
So my email is j.edwards@enigma-securities.io.
Perfect.
And the website is enigma-securities.io.
Perfect. And ours, of course, is cummingspepperdine.com. And Joseph, I think it's fair to say that any questions you and I would both be very interested to chat to people
Absolutely.
And develop thinking more. Thank you to everybody for listening, and thank you again to Joseph Edwards, Head of Research at Enigma Securities, and do get in touch with any of your ideas and thoughts. Thank you, everybody.
Thank you for having me.
Bye-bye.
Bye.